Let's jump right into it. Netflix might be cooked from overpaying for their acquisition, but with the company only expanding and reporting strong Q4 results, this will be the only Netflix video you need to watch, so stick around for my financial estimates and charts and to figure out where we should be buying. So let's go. Real quick, hit subscribe because 2026 is about to be an absolute movie, and I have actual experience working with Wall Street investors, so these videos are going to level up your investing and trading edge. Keep leaving your comments below for what you guys like to see next, and check out the other stock analysis videos, which you can find on the channel playlist. So we're going to start with what happened in Q4, figure out all the potential growth drivers for Netflix going forward, and then head over to the charts to figure out where price might be heading towards next and why the stock keeps selling off. Having a look at their most recent Q4 earnings release, we do know that Netflix is the absolute dominant streaming platform, and they only continue to grow their subscribers, surpassing 325 million, and the competition in the space has definitely picked up over the past couple of years with the likes of Amazon as well as Disney Plus, and more notably YouTube, which isn't a traditional streaming platform, but definitely has a very large market share when it comes to where people spend most of their time. And a great example of why people still keep Netflix on their paid subscriptions is because they like to offer a lot of new additions and content, which are going to be really big growth drivers for them going into 2026, as well as the fact that they're getting into live entertainment, and they had huge success with their Christmas NFL game, as well as the Jake Paul fight, which definitely attracted and retained a ton of viewers, and they're starting to dip their toes in the podcast and even virtual games, as well as other interactive forms of content where you can even vote on the show. And we're definitely going to talk about the Warner Bros. Acquisition in depth later in the video, but I'm going to skip ahead right now, and we're going to talk about the fact that their ad revenue is expected to roughly double, and it's clearly consistent in their financials. Their year-over-year growth rate for their top line revenue has only been up well over 15% at this point, and that definitely contributes to their EPS continuing to grow over time as well. So it's definitely reassuring to see that the financials for Netflix only continue to grow internationally over time. And just to recap, going back a couple of months, they did announce a 10-for-1 stock split, which is generally a good sign for management, as they believe the shares do need to be split in half so more people, according to their press release, specifically their employees, are able to come in and buy as many shares as possible. But unfortunately, I think management did a better job offering a share price discount by announcing their Warner Bros. Acquisition, which I keep teasing, but we're going to definitely get to that soon. But one growth driver I actually find interesting, and I'm really excited to see how this pans out over time, is they're opening their Netflix houses, which are interactive and immersive dining experiences that are pretty similar to what Disneyland does in the fact that Netflix generates content, and now they're offering an actual in-person attraction to monetize that and build more fans over time. I think this is a really good idea in general, especially as Netflix continues to expand and will definitely need to diversify their business in some way, but it is kind of unclear, one, how much this will actually generate in terms of revenue and margins and EPS over time, as management has not given that guidance yet, or how many they'll need at scale to actually see a material impact to their overall financials. So for the time being, it is a nice to have, but I think the real revenue growth driver is definitely still coming from their advertisement and subscription side of the business. So by far, the big investor news for Netflix is their Warner Bros. Acquisition, which is finally coming to an end and is expected to close sometime this year. They do detail that they're paying a really large premium, which is definitely a cause for why the shares continue to sell off for Netflix, and is an expected enterprise value of $83 billion, which is a massive acquisition for this company. And it's very important to point out that investors do believe at the current point in time that Netflix may be overpaying for this acquisition because they're not actually getting every single Warner Brothers asset. They're really getting their televisions, studios, and game side of the business, and a lot of their network and TV businesses are definitely going to be spun off into their own publicly traded company, which is expected to close sometime this year as well. And don't get me wrong, this acquisition totally makes sense on paper if you're a Netflix executive, as you want to definitely combine with your competition and expand your content library and monetize that as best as possible. But investors are definitely not buying it. If we actually look back to their earnings release, they actually state that they're going to pause their share buyback program in order to fund cash for the Warner Bros. Acquisition. So it does kind of raise a bit of a red flag, as investors are starting to put together that why do they need to stack extra cash on top of whatever they've already offered? Is it due to the fact that there's going to be more integration and acquisition related expenses? And at the same time, that cash is not going back into repurchasing shares in the stock market. So people who have been in the stock for a while now are likely taking profit, as they just don't know what the future holds once this acquisition is all said and done. Drop a like and subscribe if you found the video valuable so far. I make these videos on the side as I work full time, and I hope one of you you at least takes this setup with me going into 2026. As right now we're going to get into the chart next and figure out what's going on. If we actually look at a full time series on the monthly chart of Netflix, there's a couple key areas that I've highlighted in relation to moving averages. If we look at the areas that I've highlighted in red, those are the big historical sell-offs that have happened to Netflix in the past, and we're going to go each of those individually. And the orange areas on my chart are simply pullbacks that have occurred at different points in time as investors either took profits or just transitioned out of the stock in general. And the way that I'm thinking about it is if we look at the boxes below the sell-offs, that is the earnings per share on a quarterly basis going all the way back to 2012 and 2013. Netflix did issue lower than expected sales guidance in the US for their subscription growth, and the shares really nosedived following the decline in profitability as they tried to expand aggressively internationally, and costs just rose way faster than their net income came in. And it definitely took a couple of quarters for Netflix to bounce back, but we could see that the rallies are definitely very sharp and the recoveries can come sooner than most people expect. And moving on to the 2022 sell-off, that's when Netflix was seeing a slowdown in subscribers and they raised prices at the same time, which left a lot of investors confused as well, as they didn't know if Netflix was going to start hemorrhaging subscribers at the same time that Amazon Prime and Disney Plus were coming out and starting to gain more traction. But once again, if we look at the bottom hand side of the screen at the EPS, there's only one quarter that saw any sort of dip, along with the fact that the shares did form that V-shaped bottom once again. So EPS wasn't a question at this point in time because of all the lessons Netflix has learned over the past couple of years in terms of optimizing and improving their operating margins. And those shares formed a very steep V-shaped recovery. And now we're trying to figure out to today, going into 2026, where we haven't seen any material changes in EPS yet. And actually last quarter was a really good quarter for them. But the fact that we just don't know what's going to happen with the Warner Brothers Discovery acquisition, and if there's going to be any dilution to EPS, investors are all trying to sell ahead of each other and figure out if they're going to be holding the bag or if they're going to be able to get out with at least some sort of profit and just buy back lower. So at the current point in time, I'm going to mark this area on my chart as a pullback, as we do know that the price is still testing the 20-period moving average, which is that blue line on the chart, which price has respected historically and led to big rallies after. But if we do end up selling below that and closing below it, I'm going to start to figure out that this is going to be a very significant sell-off, with the stock retracing as far as almost 70% historically. And I think the next area of support, if that scenario plays out, is going to be that 100-month moving average, which is that gray dotted line on my chart there. This is an area of the chart that price is respected historically, and that's trading at $51 per share today, which would approximately be a 39% sell-off from today's price. And if you're wondering where that all leads us, all we have to do is just look out to 2030 looking at Wall Street estimates and realize that we don't have a single negative value on this entire chart going all the way from sales down to earnings per share. So it's not even a question that Netflix will be around in the future, because why else would they be completing this large acquisition with Warner Brothers? They didn't think they were able to combine and accelerate their content strategy and test out new forms of content like their Netflix House and live events. And going back to what we discussed earlier about their ad revenue only accelerating, if we actually look at how the top line revenue estimates have trended over time, looking all the way out to 2029, on the very right hand side of my screen, you can see that there's actually tails forming at the end of these charts. And that was at the same time that they did release earnings on the 20th. From an analyst perspective, as the shares continue to sell off, they do expect that revenue is only going to accelerate in the future. So when thinking about where the share price might be headed towards next, we do know that the bulls have not stepped in yet, as we don't see a lot of signs of buying pressure here, but we do know that EPS is only going to continue to accelerate out until the end of the decade. The way that I'm thinking about it is if we actually pull up the bottom hand side of my screen, which is the next 12-month price to earnings ratio in blue there, they're trading at 27.4 times forward earnings. And going all the way back to the 2022 sell-off, I think the fundamentals are arguably better for Netflix today. They bottomed all the way at a 16 times multiple, which is 10 turns lower than where we are today. And that would imply the shares would have to continue to sell off to reach that level. I'm going to definitely wait and see on Netflix and certainly follow this high growth story going into 2026. So let me know if you guys agree with the takes down below, what you guys like to see next, and check out the other stock analysis videos, which you can find on the screen now.